Welcome to my channel, Learn and Earn, to live your life on your own terms. Hello everyone, you're welcome to my channel Learn and Earn Academy. And today we are going to learn about repo rate and bank rate. What is repo rate and what is bank rate? What is the difference between both these rates? In this video, you will learn all that through. If you like this video, you can press the like button, subscribe to my channel, and also share this video on social media. So let us start with this video for the day. Now, what is repo rate and bank rate? Now, these are two most popular rates calculated for borrowing and lending activities by commercial banks. So, whenever you hear this word, the first thing that comes to your mind is lending. Lending by whom? Lending by banks, by RBI. Now, these are the lending rates at which Central Bank of India lends funds to the commercial banks and other financial institutions. Now, we as common people get loan from bank. And where does the bank get loan from? Now, the bank gets loan from RBI. And this is how the cycle of lending continues. So, while both the rates are short term tools to control the cash flow in the market, there are some differences between the two which we are going to learn in this video. So what is repo rate? Now, repo rate is the rate at which banks borrow money from RBI. In simple words, we borrow money from banks and banks go and borrow money from RBI. So the rate at which we pay loans to the banks is called the interest rate, and the rate at which the commercial banks pay to RBI is called repo rate. So when we need money, we take loans from banks, and any bank charges certain interest rate on these loans. Now this is called cost of credit. That is the rate at which we borrow the money. Similarly, when banks need money, they approach RBI. Now the rate at which banks borrow money from RBI by selling the surplus government securities to RBI is known as repo rate. Now we need to understand this basic uh, proposition of lending. If I want to loan from a bank, I need to give a security. Similarly, when a bank needs loan from RBI, they also need to give a security. Now that security is called government securities. Now these government securities can be in the form of bonds, cash, or anything which the government has kept in their custody. So this is a collateral. This is the safety which the banks give to the RBI in case the banks are not able to pay the money. Similarly, if we take a home loan, we give the mortgage papers of our land to the bank. So in case if we are not able to pay the home loan, the bank will sell our house. I'm sure this concept is very clear to you and you'll be able to understand repo rate. Repo rate is very simple. It is the rate at which the banks borrow money from RBI by keeping government securities as a security with RBI. Now, repo rate is a short form of repurchase rate. Now, if you want to know the full form of repo, it's repurchase rate. Now, these loans are for short durations up to 2 weeks. Now, which loans are we talking about? We are talking about the loans which the banks take from RBI. So, repo rate is for short duration, normally for just 2 weeks. Now, in simply, repo rate is the rate at which RBI lends money to commercial banks against the pledge of government securities whenever the banks are in need of funds to meet their day to day obligations. Now, we as customers deposit money in the banks. So they have a lot of money. However, the banks do fall short of money someday or the other day. And that is the day when they borrow from RBI because they don't have any other option. They cannot borrow from the customers. They will have to go to the regulator of Indian financial system, who is RBI. Now, bank enters into this agreement with the RBI to repurchase the same pledged government securities at a future date at a predetermined price. So RBI manages this repo rate, which is the cost of credit for the bank. Now, as I've already told you, the bank will borrow money from RBI for a short period, just for 2 weeks. So the time is decided by both RBI and bank that when the bank will return the money to RBI. So the future date is decided when the bank will return the money which the bank is taking from RBI, maybe after 2 weeks. For example, if the repo rate is 5 and the bank takes a loan of 1000 from RBI, they will have to pay an interest of rupees 50 to RBI. The same way we pay interest to the banks. Similarly, the bank pays interest to RBI. There is no difference. So the higher repo rate, the higher the cost of short term money and vice versa. So if the rate of interest is high, the banks have to pay more interest. And obviously, they will have less money to lend to people. So the bank rate plays a very important, sorry, the repo rate plays a very important role in deciding the amount of money the bank has to lend to the customers. And banks can only make profit when they lend to the customers. So if the repo rate is low, they will get cheap credit, cheap loan from RBI, and can earn more profit by lending it to people. So this is how the money is managed. So higher repo rate may slow down the growth of the economy. Now you need to understand this. If the repo rate is high, this means the banks have to pay more money to RBI. So if banks have to pay more money to RBI in form of interest, they will have less money to give it to people. So if people will get less loans, the economic activity will slow down because people cannot open new business. People cannot get more job opportunities because they are not getting finance from the banks. So higher repo rate is bad for the economy. It will slow down the economy. People will not get loans from the banks because the banks are paying more rate of interest to RBI. So if the repo rate is low, then the banks can charge lower interest rates on the loans taken by us. It's easy to understand. Now, what is bank rate? Now, the bank rate is the rate charged by the central bank for lending funds to commercial banks. Now, you need to understand this. It is the rate charged by central bank for lending funds to commercial banks. Now, earlier, the repo rate was the rate which was paid by commercial banks to RBI. Now, this is the rate which is charged by RBI, the central bank, for giving funds to commercial banks. Bank rates influence lending rates of commercial banks. Higher bank rates will translate to higher lending rates by the banks. In order to curb liquidity, the central bank can resort to raising the bank rate and vice versa. So if bank rates are more, the banks have to pay more rate of interest to RBI. Hence, less money will be available in the market. Hence, slowdown in the economy. Hence, low growth. It is so easy to understand. Impact of bank rate. When RBI increases the bank rate, the cost of borrowing for the bank rises, and this credit volume gets reduced, leading to decline in supply of money. Thus, increase in bank rate reflects tightening of RBI monetary policy. So if RBI wants, or if RBI decides that the economy should be slowed down, a lot of money is available in the market, which is not good. It is causing inflation. So what RBI does, RBI increases the bank rate. So if RBI has increased the bank rates, the bank will have to pay more rate of interest. That means there will be less money in the market, which will cause less supply of money in the market. And hence, it will slow down the economy. Money availability in the market will be less. So difference between repo rate and bank rate. Now, though repo rate and bank rate has few similarities, like both is fixed by central bank and used to monitor and control the cash flow in the market, they have some prominent differences too. Now let's take a look at the differences between repo rate and bank rate. Now, bank rate is charged against loans offered by central bank to commercial banks, whereas repo rate is charged for repurchasing the securities sold by the commercial banks to the central bank. So bank rate only involves loans given by RBI to banks. Now, repo rate is a fixed deal between the banks and RBI, that I am giving you this amount of security and I will repurchase it back on this date. So this is a written commitment between the bank and RBI. It's a deal which is done, that today I am giving you 100 crores of securities at this rate of interest. After 2 weeks, I will repurchase it back and will pay you the interest. So I'm sure you have understood the difference. No collateral is involved while charging bank rate, but securities, bond, agreements, and collateral is involved in repo rate. This is a big difference. So if banks wants to borrow from RBI, and if they borrow at bank rate, they don't have to pay any collateral. Collateral means they don't have to give any government bonds. But once they enter into a deal of repurchase agreement, which is repo rate, they have to keep securities in form of government bonds, agreements, collaterals. Repo rate is always lower than the bank rate. It's a fact. Comparatively, the bank rate caters to long-term financial requirements of commercial banks, whereas repo rate focuses on short-term financial needs. I've already discussed that. So bank rate is for long-term requirements of banks and repo rate is for short-term requirements. Now, since it's an overnight loan, the loan tenure under repo is 1 day. On the other hand, the loan tenure under the bank rate is 28 days. So bank rate is for more period of time and repo rate is for more than 1 day or 2 days maximum. Increase in bank rate directly affects the lending rates offered to the customers, restricting people to avail loans and damages the overall economic growth, whereas increase in repo rate is usually handled by the banks and doesn't affect customers directly. So thanks for watching this video. If you like the video and if you understood all the concepts, you can like this video, you can share it on social media, and you can also subscribe to my channel. Thanks. Have a great day. Bye-bye. If you like my video, please like, share, comment, and subscribe to my channel by pressing the bell icon.